Hi everyone, welcome back to another Edge Capital podcast series. In our 2026 outlook, we flagged that perpetual futures exchanges as one of the defining themes in digital assets, and one name kept coming up. Today, we're going to dive deep on Hyperliquid. It runs one of the largest derivative venues in crypto, and last year it became one of the most profitable companies in the world on a per revenue employee basis. Our DeFi analyst, Roshan Golani, on the call, co-authored a research report. So I'm going to put the questions over to him. Roshan, thanks so much for joining.
Thank you, Boback. Happy to join.
Before we get into research and all the exciting stuff, maybe we could take a step back and give us a very high-level overview of what Hyperliquid is and why we're spending this whole video on an 11-person company.
That's a great place to start, Boback. Hyperliquid runs a derivatives exchange for perpetual futures. You can think of it as the crypto equivalent of the leveraged futures, which are traded on the CME. And so these are contracts that let a trader take a leveraged position on a price with no expiry date. And Hyperliquid right now has 11 employees that generate over $1.1 billion of revenue a year. That's more than $90 million each. And for comparison, this figure at Nvidia is about 3.6 million and about 2.4 million at Apple. So as you can see on the chart, which we'll pull up, it isn't even close. This is the most profitable company in the world on a per head basis. It took no venture capital and it converts almost all of that revenue into profit. Has an EBITDA margin of around 82%. The big picture here is that business quality is not the debate. The franchise itself is exceptional. What decides the outcome from here in terms of price action and performance is one number, the share count. And that's where the research focuses today.
Fantastic. Well, thanks so much for the initial overview. So from my understanding, this is a token, not a listed company. So how do you even come about putting a valuation on it, and why should an equity investor trust this method?
Great question, Boback. We valued it the way that we would value an exchange. And so the value follows from two things, the revenue that it earns and the number of tokens that share in it. Then we read that against the range that comparable businesses trade on. Overall, we use a total of 3 lenses, each at different horizons. Lens 1 places today's earnings against peer multiples. Lens 2 derives the multiple that a full payout business deserves. And Lens 3 extends both of these out 5 years and does so on multiple potential share counts. Here's the key point though. Where the lenses disagree, it's about one question only. How fast does the locked supply enter circulation? Everything else is second order. For grounding, the token referenced at $63, a $14 billion market cap and about $1 billion in revenue, and roughly $810 million in net income. We're going to put those numbers up on the screen so you can see the key financials.
Wonderful. Thanks so much for providing an overview on that side. So on that method, in your opinion, and obviously according to your research, and the wider firm's research, is Hyperliquid cheap or expensive right now?
It genuinely depends on which share count you use, and the chart on screen shows why. So on the tokens trading today, which is the circulating supply, it's about 18 times this year's earning, falling to the mid-teens next year. In comparison, mature exchanges trade at about 18 to 21 times. So on a circulating supply, Hyperliquid sits right at the bottom of that range. However, measured against the total supply, the multiple is in the 70s, and that puts it with other crypto venues at 45 to 75 times. That dispersion is not a disagreement about the business. It's a disagreement about which share count is outstanding and when the earnings will actually land. That's the question that the 5-year lens has to answer. And one thing that stands out is that because almost all of the profit generated by the business is returned, the distribution yield runs at about 5.6% of market cap, whereas listed exchanges pay only 1 to 2. And so we treat that as a supporting point for the holding period and not as a valuation case itself.
Fantastic. Well, thanks so much for the information there. So it sounds like you're landing at around just over $80 per token, roughly 30% above where it currently trades at today's date. So walk me through where this comes from. And is this a bet on potentially a multiple re-rating?
Great question. And no, that's the important part. It's not a bet on the multiple going up. We actually derive the multiple from a payout model, and it values the token as the present value of everything it pays out in two stages: fast growth and then a slow terminal rate. It's the same dividend discount model that's long been used for utilities and tobacco stocks, and we apply it here to buybacks instead of dividends. We estimate 14% growth for 5 years, fading to 5, and discounted at 12, and that returns a 19x multiple. And the 14% growth rate here isn't hope, it's grounded in two line drivers. The first one is HIP3, the permissionless listing venue. So HIP3 lets anyone list a futures market on any asset. It can be equities, commodities, and indices. And it's gone from about 2% of Hyperliquid's total volume to 50% this year. And this is the part that institutions can't ignore. Single name equity and index perps now trade on chain all day, no expiry. And in our view, it is difficult for a fund to stay competitive without accessing these markets. The tell is the incumbent following. CME itself now lists single name equity futures, chasing the category that Hyperliquid and HIP3 opened. The second revenue stream is Circle Reserve Stream. So traders put USDC as collateral, and under an agreement with Circle and Coinbase, about 90% of the interest earned from that backing collateral now flows back to Hyperliquid. This is the same line that makes Schwab and Robinhood most of their money. The scale here is roughly $6 billion of USDC at a reserve yield, let's say 3 to 4%. So about 150 million a year that goes straight to the token holders. Zooming out for a second, you take the 19 times multiple and about $1.1 billion of forward earnings across a float of around 250 million tokens, and that gives a rough price of $83 and the subsequent 30% upside, which you mentioned.
Right, well, thanks for the insight, Roshan, on that side. So moving on to, from my understanding, there's a daily buyback returning almost all the profit to token holders, but also a lot of locked supply still to come. How do these forces net out, or how do you think they'll net out over time?
Yeah, that's really one of the key questions here. And every day the company buys back and burns the token with about 99% of net fees. And what that achieves is two things. Number one, it supports the price. And number two, it steadily shrinks the supply. So at today's prices, it currently destroys around $2 million of hype a day, roughly 12 million tokens a year. The raw unlock schedule implies that over 100 million new tokens will enter supply a year. However, because of this burn mechanism, that number drops down to actually 24 million introduced, so a quarter. Staking and burns absorb the rest. And you can see it on the chart that we'll pull up. The float is still only about a quarter of the maximum, and it grows slowly. Now, because the buyback is fixed in dollars, it retires more supply when the price falls. And that's why net growth has held near a quarter across a price range from 30 to 65. And we're going to pull up a chart here. And as you can see, over 5 years, the float caps the return, not the business. Earnings, in our view, could roughly double to about 1.6 billion. But on the tokens trading today, that's about 5% a year. On the full supply, an investor buying at spot ends up worse off. So most of the return is in year one, from revenue and a contained float. Beyond that, the growing float limits how much the payout can compound per token.
Interesting. Thank you so much for the insight there. So on to the risks. What really breaks this, and what are the risks that would actually move the case?
Yeah, I think it's simple here. Reflexivity and supply. About 85% of the fees track trading activity. So if the volatility in the crypto market collapses, it cuts the payout and compresses the multiple at the same time. That's how the bear case reaches $30. The line we'd watch are 2 straight quarters of fees being down more than 20%. I think that would end the value case. Contributors can claim about $10 million in tokens a month. This is the core team of Hyperliquid, the 11 employees and partners. And so the supply absorption case depends on them staking rather than selling. If they start to sell, that float that I mentioned previously grows a lot faster. And so from the planned 100 million that would be coming out, it would be a lot more than the 25, which is currently coming out. So I'd say number 1 risk is reflexivity. Number 2 is supply absorption. And now I can explain why we can live with both of those. Neither of those risks are systemic because both are visible on chain, and they would be visible on chain before they ever reach the earnings. And so what we think is the single number to watch is the monthly claim on the 6th of each month. This is when the team gets their allocations, and so far they've been staking it. But how much of it is staked rather than sold going forward, that would show up on chain within days of them doing it or instantaneously. And that's really the key risk to be watching here.
Thanks, Roshan. Well, this has been extremely insightful. So just to round off this video, maybe just bring it together for us. What's the one-line conclusion on Hype here?
Yeah, I think we are constructive on a 12-month view, and we're being disciplined about the reason. The franchise itself is exceptional. The earnings are growing. The buyback returns almost all of the profits while the float stays contained. And these 3 are really the key drivers for our view. The return comes from the revenue and from that share count, not being a multiple re-rating. And the price that we reach, roughly $80, $83, sits below where comparable businesses already trade today. So any form of multiple re-rating would be bonus, let's say like a cherry on top, but not something that our disciplined research takes into account. And so the discipline here, as I mentioned, is that the main risk is in reflexivity and fees. And so the supply schedule is real, but observable, and is a second order concern. The number that governs effectively the entire model is the monthly unlock. And if the fee momentum or staking behavior turns, that would be a clear signal for us to revisit the work.
Wonderful. Thanks so much, Roshan, and everyone else. Thank you so much for watching this video. As always, a quick note, this research is for informational purposes only, of our own opinions, and not investment advice. You can access the full Hype research report. We'll put the link below. Thank you again for watching, and looking forward to seeing you again very soon.
Thank you, guys.
Thanks. Bye.